Should you trust ratings? Which one should you use? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique. I hope you're doing well, Vero, and I hope that you have a better voice than mine.
Well, I can hear your soccer voice currently, Mike, and mine is doing very good because, kids didn't play hockey all summer.
Yet?
And I'm not yelling at horseback riding lessons, so all good.
That would be a bit strange.
I mean, yes, of course. I never heard somebody yelled during horseback riding, like either lessons or like competing or, whatever. It's like not allowed.
Yeah, you don't want to traumatize the horse, actually, so.
Yes. All right. So today, Mike, we're not going to rate your voice, but we are going to talk about ratings.
Love it. Love it.
Ratings can be really helpful, but they can also distract investors from what really matters. So this is what we will dig into today.
Yeah, we had this idea of talking a little bit more about the ratings because we receive questions constantly about our own ratings at BSR. So we thought, let's talk about ratings at a larger scale. And from one thing I've realized, a lot of investors are looking for shortcuts. And one popular shortcuts would be, oh, I'm going to trust this firm or I'm going to trust DSR or whoever else. And I'm just going to buy based on their ratings because they did their due diligence. I don't have to do mine. And as usual, there's no free lunch in finance. So even if you trust someone and if that person is actually trustworthy, you still have to dig into a lot more than just trade on ratings. But this is what we're going to explain today. You're going to see some confusing ratings as well. That's going to be fun.
Right. And we also often get questions about Morningstar reviews because, when you talk about a company that you like during our webinars, almost always somebody answers, yeah, but Morningstar's rating is whatever. So this is why we've mentioned it in the title. So let's not make anyone wait longer. Morningstar rating is a 1 to 5 star ranking system, but what exactly is it made of for stocks?
So, first things first, Morningstar, very well-known and popular and trustworthy financial firms. Their research is really good. They provide what I would call a non-bias rating in a sense that it's based on numbers. So it's not like the analyst that like, oh, I really like this company or I dislike it. It's just based on valuation. So the way it works, quite simple. For each companies they follow, the analysts will use their valuation methodology to give a target stock price for the next 12 months. And then the star rating applies automatically. So if the company seems undervalued versus the price target, well, the more undervalued, the highest the star rating. So if you have a company like company ABC, the valuation model for Morningstar is like $100 and the stock price is trading at like 45, well, that will be a 5-star rating. If it would be trading at 120, so above the target price, then it looks as being overvalued, and therefore it will have a lower rating, like maybe a rating of 2 or maybe a rating of 1, depending on the scale and the difference between the valuation model and the current stock price. So very simple to understand, very straightforward, 1 5 stars. You don't need a PhD to understand this one.
But then, like everything else, there are pros and cons. So what are they for this system?
Yeah, for sure. So on the good side, well, first, as I mentioned, it's non-biased. So a lot of investors will love that because they don't have to trust one analyst, but rather a system. So once it's just numbers, the number says it all. So it's either a good pick or a bad one, but it's completely non-biased. The other thing is the angle of this rating is to find companies that are a value play. So buying undervalued stocks, which is a very popular topic among a lot of investors. We love to get a good deal as investors. In the ideal world, you want to buy as low as possible to be able to sell as high as possible. So that totally makes sense. And finally, 1 to 5 star, super easy to understand. So very straightforward, just blink of an eye, and then you can look at like 5 stocks, get the rating, and then get your idea out of that. So those are the main advantages I can see. Unfortunately, there are also some disadvantages. The first one is when you think about valuation methodologies, it can vary from one place to another. So it's based on assumptions. So when I say it's non-biased by it's driven by numbers, but on the other side, there's still someone that decided that this way to assess value is the best one. And this comes from a bias anyway. So there's no way you can find a completely non-biased rating because it's either the numbers that are driving it, but someone decided which numbers are going to drive the decision, or it's a qualitative analysis as we do at DSR. So it's a mix of like numbers, like quantitative and qualitative information, and therefore there's human bias on this point as well. The last thing is it's great to look for undervalued stocks, but as we will discuss that a little bit later in the show, you can end up with 5-star ratings for a company that suck. Naming just PCE as an example. So they had PCE as a 5-star before it cuts its dividends. So while the stock price was going down and down and down and down, they rated like based on their valuation method, it just like keeps on increasing the star rating until it's 5-star, the company cuts the dividend. So, I mean, sometimes this is why it creates confusion, but when you understand the angle, it makes sense. But in the end, it's not necessarily a sure shot that if you buy a 5-star rating, you're going to make money out of it.
Right. And do you know what valuation methodology they use?
I haven't dig into that much because I'm not a big fan of valuation methodology,
Right.
so I don't really
I know.
care about that part.
All right. I was just like curious. But Mike, you often say that, and you say that at Dividend Stocks Rock a lot, ratings are not enough to trigger a buy or a sell. Is this why you totally like ignore the ones at Morningstar?
Exactly. But I would pretty much ignore any ratings in a sense that I would take into consideration, but I would not base my investment thesis and the reason why I buy a stock or I sell a stock would never be followed by somebody else's rating. The first thing is the rating is one metric. And as in any evaluation, any analysis, one metric is never enough. You cannot base your decision on PE ratio alone, or on revenue growth alone, or on the dividend yield alone. That's not enough. You need a defined set of metrics, several metrics to get a good picture of a business. The second reason, as I just told you, I don't care about valuation that much. I don't care about it because valuations are based on expectations and assumptions. And you know what? That's a complex or fancy way to say it relies on your crystal ball. Because if you look at the discounted cash flow model or the dividend discount model, for example, they are mathematic models that will give you a value for the stock price, either based on cash flow or on dividend growth. But all those calculations will be based on your expectation of growth. So if you think that a company will grow its cash flow by 5%, you're going to get X number. But if the guy besides you used the same method, but thinks it's going to be 6.2, well, there you go. You get another different model and on and on and on. So trying to find a way where you're going to find an analyst that has that clear crystal ball and will be able to project cash flow, dividend growth, or P ratio in the future and be right, like most of the time. I mean, that for me doesn't make any sense. And I often hear about investors saying, "Oh, I'm going to buy this stock when it's like $45." And I always love to say, well, why not 42 and 57 cents? Because, my calculation gave me 42.57. Yours gave 45. I mean, who's going to win, right? I mean, and the point is just, yeah, of course, it's just having fun here, but that's why it's not that important for me, especially knowing the angle of Morningstar, trying to find value play. It's good on paper, perfect on paper, but we have absolutely no proof it's going to work in the future. And I wish that Morningstars would publish. And if they do, and I'm not aware, feel free to let me know on the podcast and comment. But I wish they would say, oh, here was our ratings last year for those companies, and here's the results. And I don't even do it at DSR. Like from time to time, we do it actually. But the point is, to which extent your rating is actually going to produce better results or expected results. So saying this company is bad, well, then you expect to lose money in the next 12 months on it. and vice versa. So
Right.
based on all of that, I think the ratings are interesting because it gives you an appreciation of the stock by someone else. But that's pretty much it. So it's definitely not a big hanker in my investment process.
Okay, but are there like any other professional ranking systems that maybe are not based on valuation that you would trust more?
That's a pretty good question, but I would come back to the same point and same answer, no. And one of the reason is you can copy somebody else's idea. So you could see someone with a good rating, even if they have like good stats and proven records, you could say, "Oh, I'm going to buy this company." But you cannot copy their conviction. And it goes both ways. I mean, when on during webinars, when I talk about specific stocks, sometimes I really like the company and I'm like, I have it in my portfolio. It's a big position, this and that. But then if someone else just hear me for 10 minutes talking good about Stentec or Alimentation Couche-Tard or National Bank and says, oh, I'm going to buy it. And in the next 6 months, the stock price goes down. Well, if their sole reason why they bought it, it was because I speak good of them, well,
Hmm.
that's not enough. They will not have that conviction. They will freak out. They will wonder why the stock is not performing as Mike said it would be, which is not what I said. I just said that I love those stocks, right? So that's why it's important to have your own angles. And actually, the best solution would be to create your own rating based on
Hmm.
your strategy and what matters to you, which kind of metrics you follow.
Okay, but Mike, we do have a ranking system at Dividend Stocks Rock that consists of two ratings, the Pro rating and the Dividend Safety Score. How do you use them?
Yeah, I told you it would be confusing, right? So I just said it's not worth it. And then we say, oh, we have like good ratings here. So that's great. So here it goes. So we have the pro rating system is 1 to 5. So similar to Morningstar in terms of like the ladder. And the way we do it is it's a combination of the dividend triangle analysis. So looking at metrics, the base metrics of the revenue growth trend, the EPS growth trend, and the dividend payment growth trend. And then a mix with qualitative information. So for us, it's important that we believe in the business model, that we have a strong narrative, a strong investment thesis, and that the metrics are good as well. So it's definitely biased, but as I said, we are all biased in one way or another. The dividend safety score is more straightforward. It's really just the analysis of the dividend growth potential. So a company that will have a dividend safety score of 4, for example, will be a business that has been able over the past 5 years to increase its dividend mid-single digit to high single digit. So this is a business that shows great potential. And of course, you have like some stability behind it. If you go to a dividend safety score of 2, well, automatically it's a company that did not increase its dividend over the past 18 months. So
Mhm.
failing to increase its dividend year after year, it goes down to a 2 automatically because for us at DSR, it's more important to talk about the growth than the actual dividend. For some rare occasion, and we discussed that in the past, you will find companies rated at with a dividend safety score as a 2 at DSR that are great companies. Constellation Software and WSP Global are two great examples where management decided a different capital allocation strategy using their cash flow to make more acquisitions instead of increasing the dividend. So for several years now, both dividends have remained the same. So if you're buying those stocks, you're not buying it for the dividend growth. Obviously, you're
Right.
buying it for the total return, for the potential of growth by acquisition, which is completely different than if you buy a stock that has been increasing its dividend for the past 15 years. So it gives you a good understanding of our perception. So
Hmm.
what is interesting is if you have a similar strategy and you're thinking, oh, well, for me, it's important to focus on the good balance between a good narrative and a strong metrics, well, then it could make sense to get inspired by those. And this is a great place, even when I look for stock to talk about or to create the buy list and stuff like that, I will often look at metrics and then adding pro score of like 3 or 4 and up just to cut down the noise and clear up a few stocks, obviously, because the ratings is based on literally my strategy. For someone else, sometimes they might like companies that are
Hmm.
rated as 2 at DSR, and that's fine too. I mean, you're never going to fully agree with any firm anyway with their ratings. So it's more important to understand where it's coming from than actually buy or sell based on that. So a good way to use that is when you look at your pro dashboard and you see a lot of yellow and a lot of orange or red, so you can guess that those colors are not necessarily inspiring growth. Well, then you can take a few more minutes to analyze those stocks once again, revisit your investment thesis, and then determine, do you agree or not with DSR? And I would do the same if I was following another financial firm. Same thing with Morningstar. If I look at a company like BCE rated as a 5-star, well, then it's up to me to analyze BCE and determine if it's a good fit for my portfolio or not. And if I agree with Morningstar's angle or not. In this case, I definitely don't agree, but it doesn't mean that I will always be in disagreement with Morningstar either.
Right. Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. So, Mike, do you consider stock price or total return in your DSR ratings?
Not at all. And again, confusing for a lot of people. But here's the thing. Over the past 5 years, it's over. It's done. You cannot do anything about that. And the past performance doesn't tell you anything about the future, especially the stock price, because the stock price could be lifted by hope, by expectations, by a bull market that lifts up everything. It's not necessarily justified. So you cannot really make sense out of it. And here's a good example. What would you think of a stock that drops by 20% in the span of 5 weeks, including a bad news, while the stock market is up 3-4% in that period? So an underperformance of almost 25% in 5 years. It doesn't look like very appealing, right?
Right.
So that company is actually Broadcom in July of 2018, June and July 2018. And since then, the stock price has been up 1,300%.
Right.
So basing your decision, Broadcom sucks, because obviously it has to suck. It underperformed the market by like 25% over 5 weeks. Bad acquisition, bad news, bad return, bad results on the quarterly earnings. There you go. We flushed down the toilet just because it was down 20%. Well, that would have been a huge mistake. Of course, I cherry picked my example here, but I just wanted to highlight the fact that that drop meant absolutely nothing in long-term performance for Broadcom. And the other way around could be true as well. We have seen companies skyrocketing and then going down very fast. So if someone would say, oh, well, the past 6 months, the stock price doubled, so technically it's going to continue this way. Well, not necessarily either. So I don't think the stock price fluctuation is a good metric to determine if it's a good investment or not, especially over a short period of time. Like 1 year is a short period of time. 2 years is still a short period of time. Even 5 years, okay. But I mean, we're getting closer to midterm instead of like short term, but that's pretty much it. I mean, if you're investing for the next 30, 40 years, 5 years is not that much.
Right. I can't help thinking about Jane Mike, currently one of our DSR members, which appeared on the show about like maybe a year ago. Anyway, you highlighted Broadcom like a way back on DSR buy list, and she did buy it. And I remember that when we did the episode, she said that stock, that total return founded a lot of travels for me. So thank you, DSR. She literally said something around that. So and that's amazing. Anyway,
I love to talk about Broadcom because it's one of the rare company that I've been a big fan of since 2016. It's been 9 years and never bought it. So,
well, Jane did.
No, but and it's good. I know a lot of. It's kind of funny because I once had a comment during a webinar as well saying, "Did you get any thank you for Broadcom, Mike? Because you deserve some." But I'm like, hey, I just highlighted a stock, and then it's up to you to make your analysis. But yeah, I've been a big fan, and just to show you that I even make mistakes. So there you go.
But you know what? Talking about like stock prices and webinars, you listeners probably end up confused when your holdings like move up and down without clear reasons. And this is why we have created a new webinar to avoid stock price confusion. So, what is it all about, Mike?
Yeah, the idea came from the latest earnings where some stocks are moving, and then I get so many questions about those. Quick example, end of August, National Bank reports growing revenue, growing earnings. The stock price is down like 5 or 6% on that day. A couple of days later, Alimentation Couche-Tard reports declining revenue, declining earnings per share, and the stock price is up 6%. So it doesn't make sense in both ways. So we decided to create a webinar to help you make the difference between news and noise. We're going to teach you how to read quarterly earnings and how to analyze stocks using the dividend triangle to make clear decision and finally get out of that paralysis by analysis. Because when you see those things, you just get confused and you don't even know if you want to buy, if you want to sell, or what you should do. Well, after that, you're going to have a clear playbook to know exactly what to do in which situation.
And that webinar, listeners, is tomorrow, September 18th at 1 p.m. Eastern Time, completely free. Seats are limited to the first 500. So now is the time to save your spot for the live session. Hit pause and the subscribe thedividendguyblog.com/webinar. The instant replay will also be sent to all registrants. So if you can't make it live, register anyway to get the replay. And after the presentation, there will be a 1 hour Q&A session. Again, thedividendguyblog.com/webinar to avoid price confusions. And I'll see you in the chat. Mike, you often talk about the dividend triangle, right? Like, I mean, probably listeners know what we're referring to, but it's revenue, EPS, and dividend growth. How does that forward-looking business health lens compare to a star rating?
Yeah, I either talk about dividend triangle or National Bank and Couche-Tard. It's like one or the other, like all episodes. There you go. I prefer to look at trends. I prefer to look at trends because when you mix that with a good narrative, then you have a good story backed by numbers. It tells you a lot. It also tells you where to look because the trend is not always going up. So when it's going down, you know exactly which part of the business is not doing that well. And this is why it's a foundation for pro ratings, where it tells you not when to buy, because I don't believe that there's a specific price attached to a stock, but it tells you if it's a quality stock or not. And personally, I rather buy quality at full price than buying discount on a bad business. But that's just me.
Now, we'll give examples to illustrate the difference like in each rating and how it compares to the ones at Morningstar. So, Mike, could you provide an example of a company with like a poor rating at DSR?
Yeah, I mean, I'm gonna put another nail in that coffin, but BCE definitely BCE, because we had downgraded BCE in 22 and 23 and 24, so it went from 4 to 3 to 2 before it cut its dividend with multiple warnings, with a lot of documentation telling investors it smells bad, it smells bad, oh it's like disgusting, like run. I think it's a good example of a successful downgrade that we had, because I mean we make mistakes as well. The point of this show is definitely not to say that we're better than Morningstar, far from it. The point is just to illustrate how perceptions are different from one rating to another.
And now, Mike, how is BCE rated at Morningstar and how could you explain the difference?
So it was rated as a 5-star investment before it cut its dividend, still rated as a 5-star today at the time of recording. But here's the thing. It's based on valuation. And according to them, they see BCE value to be much higher. So they think the market is overreacting and there's a great upside potential. And that's why you have the 5-star rating. So it's just about an angle. I see it as a poor quality stock. They probably see it as a medium to poor quality stock, but that was like way under. So if you buy it, you can still make a big profit out of that. So that's their angle. And again, it's just to illustrate the difference between both.
Now, pro rating and dividend safety scores of 3 are the minimum to be considered worthy of your portfolio. So how would you describe a company that fits in there?
Yeah, so pro rating of 3 at DSR, dividend safety score of 3, it's kind of like a okay. It's okay, or we're not excited. We would put it that way. We're not excited. So it's not necessarily a bad investment, not
Hmm.
necessarily a good investment. And we could be wrong because sometimes we're not excited about a stock and it's doing well. So I've pulled out two examples here just to show you the difference. So we have Altria, ticker MO. So big cigarette seller and electric cigarette as well. So rated as a 3 and 3 at DSR. Not excited about the investment thesis here. We have discussed Altria a few times
In
over
stocks we
the
dislike.
podcast. Yeah, and in stocks we dislike. So there you go. But I mean, they're not completely bad, so that's why they're rating as like an okay stock. And they have a similar rating at Morningstar. So they have a 3-star rating as well. So pretty much similar here. Where it gets interesting is we have Campbell Soup. Campbell Soup, I mean, consumer staples, thin margin. The stock is not performing very well. And if you look at the dividend triangle, you can see why. I mean, the dividend triangle is pretty weak. So it's rated as a 3 for the pro rating, dividend safety score as a 2. But as the stock price plummeted over the past 12 months, if you look at Morningstar, it's a 5-star rating. So again, you see the angle of a value play being super important for Morningstar. And on our angle, it's a quality angle where the metrics doesn't justify a strong rating. And this explains the difference between both.
And how about businesses receiving ratings of 4? What examples could you give?
So here I've selected two examples with different ratings. So AbbVie, we love AbbVie at DSR. So rating for pro rating and dividend safety score, very long-term dividend grower. I love the fact that they have like a big pipeline. They made an important acquisition several years ago going into Botox, so aesthetic as well. So that's why it's rated as a 4 at DSR and kept increasing its dividend high single digit for several years. At Morningstar,
Mhm.
it's a 3. So probably like well valued, not super exciting. So on that side, I could agree on both. I can see people not being super excited by AbbVie. I kind of like it. So it's all right. It's all fair. Another one that is interesting is Telus. Telus is rated as a 4 at DSR, mostly because it's a great play on the wireless industry. They generate more cash flow than they were. And I continue to believe in their growth vectors. So TELUS Agriculture, TELUS Healthcare, and TELUS International. Over the past 18 months, the cash flow situation has improved greatly, and they have maintained their dividend growth policy. So they changed it a little bit. Of course, I'm not expecting 7% going forward. The guidance right now is between 3 and 8. I would say if I get 3 or 4% every year, I'll be happy. I don't expect
Mhm.
necessarily more than that. But as you know, TELUS stock price has got beaten up pretty nicely over the past 4 years. And
Mhm.
Morningstar gives it a rating of 5 based on, again, on the valuation. So you can see the difference between where here we have a stock that is rated, highly rated at DSR and also highly rated at Morningstar, but for completely different reasons. And of
Right.
course, I'm not saying that Morningstar dislike TELUS, but just based on valuation, they're going to give it 5-star. But again, adding context and making a better analysis will help you understand where it's coming from.
Now we are going to reach the top, like the best of the best, right? Ratings of 5, which are not so numerous dividend stocks. So could you give a few examples?
From the top of my mind, I think we have like 10 stocks, maybe less. So it's not a long list. I mean, to be rated as a 5, you need like high single digit to double digit growth everywhere. So we have Dollarama, for example, that has a what I would call the perfect dividend triangle. Everything goes up all the time. It's kind of crazy. So we have Dollarama, Microsoft, and Visa. I don't really need to explain you the business model or where they're coming from.
Mhm.
Ironically, when you look at Morningstar, Dollarama is a 1-star rating. So they're going to just say it's greatly overvalued. I would be interested in seeing the star rating over the years because Dollarama looks like an overvalued stocks for the past 15 years and generated crazy returns. Microsoft, ironically, is rated as a 4. So they give even more value to what's coming up. So if you're discouraged by today's Microsoft valuation, trading close to an all-time high, PE ratio above 30, well, guess what? You're in for another ride. We both agree, Morningstar and us, that Microsoft is an amazing company. And then for Visa, similar thesis than for Dollarama, it's rated at a 2-star rating, pretty much, again, aligned with the valuation angle. So as you can see, at DSR, we will value a lot more the quality of the metrics.
Mhm.
And then we could argue for the entire day that those three companies are overvalued right now, and you should wait until there's a better pricing. And I mean, I'm going to run out of argument pretty fast because we don't know. We have absolutely no clue. Maybe it's the best price ever. Maybe it's the worst price ever. We'll know that in like 5 to 10 years. So
Hmm.
let's wait and then we'll see. In the meantime, I prefer to have them in my portfolio.
Right. And it brings me back to a sentence that you said many times, which is like stock price is not a reason to buy and it's not a reason to sell.
There you go.
So in summary, Mike, what's the right way for investors to use ratings?
So the point of that episode, kind of obvious, but rankings are confusing. So focus on one that you like and it's going to be more consistent. Because if you add 3 or 4 ratings from different firms, you're going to end up with just paralysis by analysis, like plain and
Hmm.
simple. The point here by looking at Morningstar and our ratings was to highlight that 2 different angles will give you completely different ratings. And then you
Right.
would be stuck between like, I'm buying a 1 star, but a 5 rating on the other side. That doesn't make any sense. Again, it's one metric out of many. So what I always tell DSR members is when you see that we don't like a stock, so we give a poor rating, ask yourself why. Like, are
Hmm.
you able to explain it? And once you have explained it why, then you can decide if you agree or not with our theory. And in the stock card, it's kind of explained as well. So then it's up to you to determine, make your own boss of your portfolio. You're the manager here. So then you can decide, yeah, well, DSR doesn't like that company, but I do. And I have reasons for that. And that's perfect. On the other way around, it's exactly the same thing. If we like a stock, well, ask yourself why. And do you believe in those reasons? Because if you
Hmm.
don't, well, then you won't have the conviction to hold those companies throughout the storm. And that's the most important part because we are making bad decisions when we're not convinced about what we have in our portfolio. We are going to be able to move forward and make better decision if we have that level of conviction. So then we kind of like take down the emotions and focus more on a rational approach on an investment process, focusing on rules that will help you move forward, move quicker, and most of the time do better. Your batting average is going to be a little bit better. So you're going to make better decision overall.
Mike, let's end with that, like a personal note. I'll be honest with you, and I know I'm not the only one, so maybe it's time to clear that out. I only look for DSR ratings of 4 and above in my portfolio because I don't want to hold like more than 20, 25 stocks. So to me, it's like I really want to have what I consider the cream of the crop. And because this rating is based on quality, like you've mentioned, I go for that. But am I mistaken to use them that way?
Well, we started the episode by saying it's not because you're making a value play and you're buying an undervalued stock that you're going to make money. Well, we can say the same thing about quality metrics. It's not because you're
Mhm.
buying a stock with quality metrics that you're going to make money either. Personally, I start my filter with the dividend triangle first. And I usually include the threes as well, just to make sure I did not miss anything and my team did not miss anything in their analysis. And I let the numbers speak a little bit louder. But even then, that's a great way to just narrow down your research. So even if you search by fours or by any other stock rating and just say, yeah, I'm just going to pick the best one, that's not a problem. But it's just the beginning of your research. So you narrow
Mhm.
down your list. And I mean, that's the whole point of having filters, right? You want to have
Right.
filters to narrow down the list. You don't want to analyze like 500 stocks. That doesn't make any sense. So once you have a shorter list of companies to analyze, then it makes it easier to actually spend the real time understanding the business model, looking at the playbook, looking at growth vectors, looking at economic moats, and write down that thesis. You won't be able to do that for 272 stocks. But if you have like 50 and then you select 1 or 2 per sector, well, there you go. So you can do that kind of filter and say, yeah, I'm going to just pick the one that this firm already like, and then I'm going to focus on a few companies where I'm going to spend a few hours to understand a little bit more why should I buy, or if it's actually not a good idea to add it to my portfolio. And this is how I would suggest investors do it. So this is how you're going to build your conviction and you really understand what you own and why you own it.
All right, Mike, thank you. It's always like a pleasure to learn from you. Listeners, remember to save your spot for our upcoming webinar, which is tomorrow, to avoid price confusion at thedividendguyblog.com/webinar. webinar. For our show notes and related content, visit thedividendguyblog.com/245. Do not miss any episode. Hit pause and the subscribe button underneath our podcast logo now to get notified. And until next week, or maybe I should say until tomorrow, stay invested.
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.